Hey everyone, Grayson Roze here with Stock Market Mastery. Recently, I joined my Tensile Trading co-author Gatis Roze, and we sat down with the American Association of Individual Investors, the AAII, for a very special three-part Family Day event. We were hosted jointly by the Los Angeles and San Diego chapters, and they asked us to come share our experience, more than 50 years of combined investing experience between the two of us, share how we approach the markets, how we manage our own money personally as individual investors, but also talk as a father-son team, as a father-son duo who has made investing a true family activity. Talk about how we've navigated that between the two of us, sort of across the generations, if you will. So we had a blast presenting this seminar. It was in three parts, each part about an hour long. Today, we're going to share with you one of those three parts. Now, we have all of them available up on our Stock Market Mastery YouTube channel, so you can always check out the full presentation by linking to all three of those parts back to back. First up, in Gatis' segment, what he talked about was the most impactful investing lessons that he taught his son, me. So he got to dig into all of the lessons that he shared with me to teach me how to approach the markets, how to protect your money, how to grow your money, everything that he learned that he thought made the most impact on me as a young investor growing up. Those are what Gatis got to cover in this very special presentation to the AAII. So I'll let him take it away.
I guess there's a disclaimer here on the title. It implies that this is sort of a one-way street, but I could give you a whole other talk on impactful lessons that my 27-year-old son has shared with me, and there are plenty. So just an intellectual property notice. I put this up because the question you should ask is, why do you want to spend a Saturday morning with me? And I'm grateful that you are, but I think the three quick reasons are, I spent the first half of my life as a four-time entrepreneur. The past 25 years, I've been managing my own money, and I don't manage other people's money. I have no clients. I tend to be somewhat irreverent about, I'm an individual investor like you are. And after teaching college for 20 years part-time and writing the Trader's Journal blog that I've done for over 10 years for stockcharts.com, I hope you'll find my comments candid. I'd like to poll the audience. I'm going to count everybody's hand. So put up your hand if you know anybody who's a doctor and their kids became doctors, or they were accountants, or they were engineers and their kids became accountants or engineers. Anybody know? Anybody name any sports figures that, father-son teams, like perhaps the Andretti's, Mario and Michael, or Ken Griffey, Senior and Junior. So Barry Bonds and his dad. So there's, in a couple of cases, maybe it's a genetic problem, but anyway, let's jump into it.
Yeah, it's just by the way, there's a raise hand feature on this, and 40 hands were raised when you asked that question.
Oh,
so
good.
we can do polling. If you want to ask questions of the audience, I can let you know how many hands were raised.
Okay, that was the last poll.
Okay.
Let's go on to the next slide, which is money mentorship. And the objective of this is mostly about, this presentation today is about how, when, and why we parents should communicate with our families about money. And the agenda really is using these four legs. I'll call it the mentorship metaphor. So the approach that I suggest is, one, focusing on the motivation of young people and how to motivate them to listen to you talk about money and understanding money. The second is understanding the investor self. The third is just the tools. And then the fourth is actually jumping in and taking action. So let's move on to the first one. My hot button is that, and there's a lot of research that supports it. Talking money is sort of taboo. And so I hope you don't put money discussions in the same arena as, sex and Uncle Wendell's drinking problem, that sort of thing. So I also think that stories, if you can frame your experiences as a parent in stories to talk candidly, that will help motivate. Obviously, when we were younger as a family, we played Monopoly and that sort of thing. But there are a lot of board games, zillions of board games and online games. And then I remember when Grayson was just probably 5 years old, we went to Key Bank and he opened an account. It was called the dinosaur account because the 5-year-old was given this large plastic dinosaur. So the first step is motivation, but it's to talk about money and saving, talking about saving. Grace and I know we'll talk more about that. And then there's the old famous Chinese proverb that says, wealth does not pass 3 generations. So that's a challenge. Keep that in mind. Let's go to the next one. The next slide is about the investor self. And the bottom line in this section, this leg of the table, is really a discussion about emotional and behavioral control. If for those of you that are active in the stock market or even buy and hold people, you'll know that the investor self is really the main thing that separates exceptional investors from average investors. Academics call it, of course, behavioral finance, but in our book, in the third chapter, the third stage is all about the investor self. So it's 10% of our book. And it talks about things, emotional, behavioral things, but it also talks about the 5 stages of investing, which are novice, advanced beginner, competent investor, proficient, and then finally expert. And you cannot pole vault. Despite your IQ, you can't sort of pole vault from one to another. So let's go to the next slide. This one deals with tools, skills, routines. In our book is laid out in these 10 stages of mastery. It's a roadmap. I'll show you that here in a little bit. But I'll show you some tools and what I call rational analysis. We'll talk about that a little bit later, where you combine fundamentals like earnings with charts, which are technicals. So this is the most teachable portion of the investing roadmap. And it should really be a two-way street. And then finally, step 4 is the action component. And to get engaged and actually execute, and I think Grayson will also talk about that, not getting caught in this analysis paralysis. The stock market and money management attracts a lot of very high IQ people. And frankly, those people are trained to ask why things happen, and they want a lot of information. You're not going to ever get 100% of the information that you would like when you're dealing with the stock market. So it's all about dealing with probabilities, and we'll talk about that here in a little bit. And then understanding the costs and fees, and we'll talk about that in a bit too, how much that really matters. The next slide is something that Stock Market Mastery is the title of our book, but the whole book is really about doing these small incremental steps to shift the probabilities in your favor. There are specific things that you can do, and the book obviously is filled with those. And you can see that this simple little graph shows you that as you master the 10 stages, your probability of success goes up. And an example of that, for example, is it's a tool you can use for free on stockcharts.com. It's called Seasonality. Well, Seasonality is just a fabulous little probability enhancer. Even large companies like Apple, for example, in the last 5 years, this little tool will show you that 100% of the time over the last 5 years, a big company like Apple has gone up an average of 7% in July. it also tells you that 75% of the time in September, Apple has lost about 2.5%. So take a look at Microsoft. It works for ETFs, mutual funds. It's just an example of things you can do to goose your probabilities just a little bit. The next slide is really the basis of our book and the roadmap to success, as we call it. And it starts with money management and asset allocation. It talks about chapter 2. The stage 2 is the whole business of investing, having great computers and organization. Chapter 3 is the investor self, the all-important investor self. 4 is market analysis, how to approach the market, what you're going to look at, how you're going to analyze it. Number 5 is routines. You can't be a successful investor and replicate your successes and purge your losers unless you have routines. Stalking, what are you going to be focusing on like a lion? You're picking your prey. And then you'll notice buying is stage 7. We've gone through 6 stages before we get to actually buying. And then stage 8 is the essentials of, okay, now you own it, monitoring it. Stage 9 is selling, where you take money off the table. And 10 is just revisiting this whole process. So if you really want to teach your offspring about this, here's a lovely book. You can buy it on Amazon, or Stock Charts has it, or whatever. And it's really about having a roadmap to follow. Sort of an interesting story on this. When Grayson and I finished this book, the book was it's filled with his metaphors and analogies, because him being a millennial, and our publisher Wiley really liked the metaphors and analogies. And so they didn't ask me, but they went to Grayson and they say, we own the Dummies books franchise, and we'd like you to write a Dummies book. So Grayson actually wrote Trading for Dummies, which is sort of written in the voice of a millennial. So next slide is just for you. It makes a couple key points, but for you younger folks, this is called an uptrend. My point is that history matters. This is the Dow Jones Industrial Index. And, us gray hairs, we do things a little differently, but you don't want to start out late. For you young people, the sooner you start, the more money you'll make, because you've got all those years on your side. So this is worth your time. You will be able to retire early, and it's a great lifestyle. At least I think Grayson and I will tell you it's a great lifestyle. You can make money lying on the beach in Hawaii, that sort of thing. Okay, next slide. This, you may at first blush go, why is this guy talking about potholes or blunders? And a paramount objective of investing is to protect your assets, not lose money. And so you can be a big success if you don't do silly things. So don't snicker. It's an investment strategy all unto itself. So in the next slide, you'll see that this is Warren Buffett and Charlie Munger. They've run Berkshire Hathaway since 1965. And if you had invested $10,000 in their fund in 1965, at the beginning of 2020, you would have had 275, wait for it, $275 million. The point is, they know what they're talking about. So, pay attention. And they're basically saying, Charlie here is saying, it wasn't that we were so brilliant. It's just that we didn't step in the cow dung too much. So don't be stupid. So the next slide, I'm not going to go all of these, but a couple of them, how important it is to avoid, for example, young people, if you can start saving early, my gosh, the magic of compounding puts the wind at your back. Then one of my favorite ones, the credit card debt, understanding that credit card debt can kill you, and doing everything you can to avoid that. Financial laziness or procrastination. I could share with you many personal examples I've had of friends and family and students who for years and years and years said, yeah, we're going to start, and by the time they're in their 50s, I don't want to say it's too late. But the next slide again, it has a number of these blunders, things like the last one here. It's basically snooze, you lose. And there's a great list that IBD's founder, William O'Neill, put together after many years of experience. And it's a long list of his observations about basically stupid things that investors do and shouldn't do. So, holding on to your losses. We're going to talk about getting out of positions and stops here in a little bit. But and then yes, I use charts. I'm not exclusively a chartist, but not using charts or being afraid to buy. These are all things that if you don't embrace them, your probabilities of success are going to go be diminished. So, okay, enough about potholes. Let's talk about discipline. You hear about discipline in sports. You hear about discipline in your job, in life in general. Discipline is a huge part of rational investing. And like the first point here, impulsiveness is really deadly. If you're an impulsive kind of person, go to Vegas with $10,000, have your fun, but don't use it on this kind of system. I've spent over 2 decades teaching people in college, continuing education. So, the average age of my student is about 55. But my trading buddies will ask me, why is it that you teach? It's not the money. Well, it's really about discipline. I'm a very disciplined guy. And at least my wife and son tell me that. If you talk the talk on Wednesday night in class, you better walk the walk on Thursday. And so I suspect that it helped my own discipline by teaching. So that was very very important. Stick to your routines. Another key point here, it says it's not about IQ. A lot of very, very high IQ people have lost a lot of money in the market because they have some bad personal attributes. So the next slide is the flip side of discipline is emotional control. And that's why it's a very significant chapter in our book. Understanding your own weaknesses and strengths, understanding what your personal beliefs and baggage are, what you bring to the table. There are many, many academic studies that show that the investor self really determines the majority of your success in the stock market. I can't understate that it's really, really important. And as a parent, you can't pass the baton to your child if you don't have a brutally honest picture of your own strengths and weaknesses and your own beliefs and baggage. So you've got to be brutally honest with yourself. So the next slide is what I said earlier, is that buying is stage 7. I've had a number of friends over the years accumulate significant wealth as entrepreneurs and stock options and that. And they come to me over coffee and they say, Gatis, I want to do now what you've been doing for 25 years. They want to trade in the stock market. And when I pull out my book and I show them the 6 stages or the 6 foundations that are necessary before they really start buying stocks, which is the sexy part, they're crushed. But like building a house, spending money on a deluxe foundation is the smartest move you can make. So that's my point of buying is stage 7. There's a lot of foundation building that you have to do, and we're going to talk a lot more about before you do address the growth part of your portfolio, buying stocks and ETFs and that sort of thing. Asset protection is really important. Avoiding this, random bumper car approach to investing that'll kill your riches or ruin your estate. So here are some strategies, but we're going to talk about how it all fits together. So the next slide says, how does it all fit? Excuse me, I have to lubricate the voice. So step 1 is asset creation. We talked about buying is step 3. Step 2 is where we invest and devise our core portfolio. We're going to talk a lot about asset protection. And as I said, you have to protect your assets first and foremost from calamities. Of course, the government is always trying to take your money from, scams, and there are a million people, different ways that are always trying to remove you from separate your money. So one group that you protect your assets, obviously there's things like insurance, estate planning, tax planning, proper accounting. It sounds mundane, but it is important, foundational. And then another group is what we're going to focus here is core investments, safe long-term investments. The objective here is less growth, but maintaining your assets. And then we'll talk about actually, in fact, an asset allocation program where the third step is asset growth. So let's go to the next slide. We'll talk a lot about asset allocation, and I'm sure a lot of people have heard a lot of different things constantly about how it's extremely personal, and Grayson and I, for example, are very different investors, and we have significantly different asset allocation models. I'm going to show you specifically mine, but I'm a gray hair and he's a 27-year-old. You would expect that our asset allocations are very different. But asset allocation is nothing for you young people listening. It's really just the cliche of don't put all your eggs in one basket. There's a lot of trendy investments out there that you can get into, and don't break that rule. It's a long-term, historically relevant, significant rule that hasn't changed. The next graphic is a little complicated, but it's from our book, and I'll just try to explain. Focus on the left-hand side. What you see are 59 different asset classes. Grace and I reviewed, there are thousands of asset classes on ETF.com. There are hundreds of asset classes on Morningstar. We spent a lot of time winnowing this down to these 59 and reviewed it with a lot of our investment professional friends and that. And so what you're seeing is it's a correlation. For example, these are the correlations to the S&P 500. So VTI is a Vanguard Total Index fund you can invest in. But if you invest in that, you are 99%, your performance will be the same as the S&P 500. Versus if you look down the list, if you invest in biotech, for example, XBI, it's a basket of biotech stocks. The correlation to the S&P 500 is only 41%. And then look down even further, you can see their bonds that have an inverse relationship. In other words, when the market goes up, they go down, and vice versa historically. So this is really important to understand, but the book will focus much more on that. The middle, the core, these are the 19 asset classes that I personally invest in. We'll talk more about that. And then something called Explore. These are the 10 equities that I'm using for the Explore portion. So let's go to the next slide. This is probably the highest leverage activity you can do. So we actually, Grayson and I put together a 6-hour DVD. We were hoping it would be put in the book, but Wiley said it would make the book too expensive. So if you want to get better on your asset allocation skills, please take a look at this. I know it's not sexy to go to a cocktail party and people don't ask you, what's your asset allocation? They ask you, you know, what stocks are you buying? So unfortunately, though, 80 to 90% of your profitability, your bottom line, is determined by your choices of asset allocation. So in the next slide, I'm just touching on the core part of the portfolio. It should be anywhere, this should be anywhere from 80 to 100% of your portfolio. The objective here is asset protection. You're using market indexed core holdings, both ETFs and mutual funds. And the prerequisite here is that protection. You're not focused on growth. For example, I've had Vanguard Healthcare in this for well over 25 years, and I'm very pleased with the results. So most of you should have at least 80 to 100% in here. On the next slide, what we do is, this is where we go for the Explore portfolio, is the part where I call it ego investment. This can be 5%, 10%, 15%, anywhere up that range as you get more competent. This is where you're investing in growth. You're investing, the objective here is to invest in a maximum. In my case, it's a maximum of 10 positions, which I showed you. Grayson has a different take. And I wrote down here that constant vigilance is the price of profits. You really have to watch those 10 positions very, very carefully. So I like liquidity. I buy big cap growth stocks. I don't buy small caps. You can see here my Explore portfolio. These are all large caps. And I will admit, I am an earnings junkie. On the fundamental side, I follow earnings surprises, earnings growth, etc. All of that very, very closely. Okay, another probability enhancer is fees. Constantly looking at fees. And you say, oh, well, why does it matter? Well, in this little graph, you see two brothers, David and John, that invest the same amount of money in exactly the same, hypothetically, in the same equities. And one of them decides to, John decides to invest with a money manager who's going to charge him 1%. Well, look what happens. By the time they're 85, David has 50% more money than John. He's got $450,000 more because he didn't pay that 1%. So fees do matter. I applaud, especially when you, I applaud the AA, for example. They had an article last week about VFIAX, which is a Vanguard S&P 500 fund, and RYSYX, which is a RIDEX S&P 500 fund. They invest in exactly the same portfolio, but because fees are different, after 10 years, your Vanguard fund has 24% higher return. So fees matter. They come in all sorts of flavors. There are, for example, American Funds has 17 flavors of the same mutual fund. And the difference is that they have a different collection of 12B1 fees, front-end loads, back-end loads, crazy fees. It's nuts. Okay, on to rational investing. Fundamental analysis is the part where we talk about earnings and sales and that sort of thing. It's sort of what the traditional investors sort of gravitate to. Technical analysis is, think of it as charts. charting the Microsoft, for example, it would show you the prices of Microsoft, which is called technicals, over a period of a week or 2 weeks or whatever. It's just reflecting what's going on with the price. I call myself a rational investor. I'm in the middle. So that's where I'm investing. I blend both of those together. On the next slide, I'd like to elaborate a little bit more on charts, because I do think they're a very powerful tool. And they're very easy to understand. I know Grayson's going to talk about that was the first thing he and I started when he was 10 years old. So, accountants, engineers, doctors, everybody, professionals, they're all trained to ask why. Well, in the stock market, if you ask why, or you wait until you know why, you'll be late. The market will reward you as an investor if you know what's going on. So pull the trigger when you see the chart telling you, okay, bad buyers are bidding up the price, that's good, or sellers are pushing down the price, that's bad. You may sell out of a position and suddenly weeks, months later, find out why. Okay, enough of that sermon. So the next slide is talking about one of these tools, these probability enhancers that I talk about, that we talk about in the book. And a big part of, in nature, for example, everything deals in groupings, birds and animals and plants and all that. The market, stock market runs on something called the law of groupings as well. The stock market is divided up into 11 slices, 11 big sectors. So think of one pie divided up into 11 pieces. Those are the sectors. Each of those sectors is again sliced up into different industries. IBD slices up the industries different than, for example, the Dow Jones industry groups. But we're still slicing up the same big industries. For example, the utilities sector is one of the 11. That is divided up into 4 industry groups: electricity, water, gas distribution, and multi-utilities. So I tell you that because this is the chart that I think on one chart tells you a lot. The first one, and we're using Alphabet or Google as an example. The first one here shows you, asks the question, how is Alphabet doing relative to Vanguard total stock market? The next one asks the question, well, Alphabet is part of the communication services sector. How is that sector doing relative to the market? The next one asks the question, how is the industry group that Alphabet belongs to doing relative to its sector? And then the last one is, how is it doing relative to its industry group? And you can see when those are trending up, you have a very, very high probability of making money. The next slide shows you another probability enhancer. We've talked about discipline already. If you don't have a selling strategy, and in the book, we have many approaches, but this is the most basic. We call it the 3 peaks approach. And basically, it's back to what I said earlier, sell and ask questions later if the chart is breaking down. So this approach is for novices, but I think you get the idea. It's very, very effective. Let's go to the next slide and show you General Electric. For example, long before the media and the fundamentals were starting to deteriorate with General Electric, we were seeing that it was making on the chart, it was failing to make new highs. So you had it's like baseball, 1, 2, 3, and you're out. So it's better to sell and ask questions later, because it was, more like October and into 2018 that all the reasons came out why you should have been selling General Electric. But at the time in in 2016, 2017, you didn't know, but the chart was screaming at you, this is not going well, take some money off the table. The last chart, and I must say, I feel as though this is a little bit like a venture capital elevator pitch. You know, you get on an elevator with a venture capitalist and he says, okay, I've got 30 seconds. Tell me all about yourself and your company. So I feel like there's so much that I've had to leave out. But as I said earlier, I spent 20 years teaching college, and Grayson and I have done a lot of these boot camps over the years. And from over 5,000 investors, individual investors, much like yourself, I've come to observe two things. And one of them is you need a methodology. It's got to be personal and whatever it is. And the second part is you need an organized process and routines. You can't produce consistent growth in your portfolio if you don't have a solid methodology that you buy into and a series of good routines. So my sort of closing caveat here on my next slide is for money and investing, and in an arena that has been very, very good to me over the years, you must be willing to change and to grow. This quote from Charles Darwin says, you got to adapt. You survive if you adapt, and it's got nothing to do with IQ. If you've got some crazy IQ and you don't adapt, you'll lose money, you'll die. So the last slide is I'd like to encourage you to stay in touch with us. This is our little, Grayson and I have this little educational website that we maintain called Stock Market Mastery, which we're actually thrilled to say we trademarked. We got it trademarked, so I'm very impressed with that they gave it to us. But so you'll see my blogs, our blogs appear on this, and for those of you after COVID, we'll start up. Once a year we do a 2-day boot camp up here in Seattle. So we basically spend with a dozen investors. So if that sort of thing interests you, send us an email on the site. And now I'll pass the baton back to Fred, who will hopefully pass the baton to Grayson. So thank you very much for your attention.
Okay, great talk. And once again, a lot of information on those blunders and potholes. And I'm looking forward to having your deck posted on our website. I know our members would be very excited about seeing that information, because you were so much information and you were going through those slides so quickly when you had all that information. I do have 2 questions for you, and then we'll move on to Grayson. The first question is asked by Richard Krause. This is a good question. How do you identify and understand your investor self? Are there questions to ask or ways to measure?
In the book, there's a study that I did. I had a class one semester with 115 investors. And again, their average age 55. I was shocked to find out in the survey that the average liquid net worth was 1.5 million. So these are not undergraduates. These are not, kids. And I asked them, what are the roadblocks over the years that have prevented you from becoming a more successful investor? And I thought it would, take me a week or two to pull all that stuff together, but everybody responded with such passion that it took me almost the whole semester to synthesize all that down into 4 roadblocks, which is in the book. You'll see they're basically questions that you go through and say, is this an issue that I'm having? I have a blog called The Trader's Journal. It's called The Trader's Journal because I'm a big believer in keeping a daily journal of your investing and as a tool. So, it's hard to answer that question in a minute, but certainly check out the book. It's a matter of looking in the mirror and really being candid about your weaknesses and your strength. There's another great book called Trading in the Zone check that out. It's the whole book is just about that particular, to answer that particular question.
Okay. Here's the other question asked by Bako Lala. Do you consider point and figure charts still relevant today in combination with relative strength charts?
Point and figure charts are all about probability, and IBD is based on breakouts and you know, accumulating it. And I teach a whole segment on point and figure charts because they've worked fabulously for me over probably 20 years now. There are different people that Dorsey is the man to go to about learning about point and figure charts. But think of it as a big coil. Like this is sound like I'm from IBD, but you know, William O'Neill talked about you're in a trading range, and then it sort of generates energy. Well, what's going on is the big institutions are accumulating it while it's going sideways, and the point and figure charts show that, and then you can actually do a count and project on the upside. You asked about relative strength. Well, relative strength was that whole chart I showed you. I'm a big believer in relative strength as it applies to, you know, ask yourself, how's the stock doing relative to the market? How's the sector doing? How's the industry? When those four graphs align, the relative strength, I don't want to say you've got a sure bet, but boy, your probabilities just got goosed. Combine that with the point and figure charts, and the probabilities are in your back pocket.
Okay, great. Thank you. Okay, I'm going to turn it over to Ryan now, who's going to introduce our second speaker. So Ryan, if you want to join us, thank you.
Yes, thank you very much, Fred. And actually, if you don't mind, Gatis, I'll just throw in one additional question before introducing the next speaker. You spoke at the end there about the importance of being able to adapt. But we also know it's important to stick to the principles, kind of stick to our guns. How do we balance those two things? It appears like they might sometimes be in conflict. How do we know this is a good time to adapt versus this is the time we need to stick to our guns and not change?
You know, Ryan, that's a great question, but it really applies to many different levels. Adapting can be something as simple as, you know, you buy a particular stock, don't fall in love with it. Unfortunately, I have a pilot that lives on the street here that used to fly for an airline that will go unnamed. And, you know, he unfortunately was unable to adapt, if you will. He fell in love with the stock. So, you know, that whole series about don't fall in love with your stocks, but then your methodology, it can't be rigid. You have to be able to adjust and tweak it. And I've done that with input, for example, from Grayson. I mean, Grayson knows everything and about stockcharts.com has these fabulous tools that I wasn't even familiar with, and he brings them to me. So, you know, us gray hairs have to adapt to new tools, new perspectives. And then about yourself, I can't say enough about writing a journal, a trading journal, which I've been doing for, 30 years, and been writing that blog about being pretty candid, brutally candid about my own blunders. That being able to change your own perspective about yourself. And hey, these are my weaknesses. These are my strengths. Boy, if you're rigid, I don't know, is that the opposite of adaptable? But that's really where I'm coming from. You know, you can't be a gray hair and be stuck in your ways as the market's changing.